What they did not know on that Friday in January was that 11 days earlier, the Comex Board of Governors had quietly met in this room. The board had written a rule. The rule did not name the brothers. It did not need to. When it took effect, 6 weeks later, it was going to break the corner before the brothers knew they had been beaten. In January 1973, 1 ounce of silver traded at $1.95. 7 years later, the same ounce hit $49.45. The price had roughly 25-tupled. Then on March 27, 1980, in a single trading day, silver was cut in half. Someone had failed to meet a $135 million margin call. The someone was not standing on the trading floor. He was in Dallas with his brother, Nelson Bunker Hunt and William Herbert Hunt, sons of an oil billionaire from East Texas. Their father, H.L. Hunt, had told them repeatedly that money was dirt, that paper currency was the most untrustworthy thing the United States government had ever issued. The brothers believed him. The brothers had bought roughly 200 million ounces of silver, about every available ounce of the American silver float, held privately or owned through futures contracts that demanded delivery. The total American silver float in market hands was roughly 200 million ounces. The Hunts and their partners held an equivalent figure in physical bullion plus Comex futures contracts. If you had to deliver silver against a contract, you had to come to the Hunts. They had cornered the market. By the early 1970s, Bunker had developed a thesis about American money. He looked at the Vietnam War. He looked at the unfunded promises of the Great Society. He looked at the price of bread. He concluded that the dollar was about to lose roughly a third of its value over the next 5 years. The standard hedge against that was gold. But private American citizens could not legally own gold bullion in 1973, so Bunker looked at the next best hard money. In January 1973, silver was trading at $1.95 an ounce. Bunker placed his first major buy order. Herbert managed the brokerage relationships. By the end of 1973, the brothers held roughly 30 million ounces of physical silver in vaults across Texas, New York, and Switzerland. For 6 years, the brothers bought silver, patiently. In 1974, when President Ford signed the bill that made gold ownership legal again for American citizens, the brothers did not sell silver and switch. They kept buying. By 1976, they held about 50 million ounces of physical bullion plus growing futures positions on the Comex. By the start of 1979, silver was at $6 an ounce. Their average cost basis on the early position was under $5. Most of the bullion was held abroad. The Hunts moved silver into Swiss vaults to avoid the political risk of an American confiscation order, a fear they had inherited from their father. By the late 1970s, the logistics had become its own problem. The brothers had to charter aircraft to fly bullion across the Atlantic. They had to ensure shipments at rates ordinary commercial carriers refused to write. In the middle of 1979, the brothers did something they had not done before. They took on partners. International Metals Investment Company, a Bermuda-incorporated partnership between the Hunts and a small group of Saudi investors led by Sheikh Khalid bin Mahfouz, founder of the National Commercial Bank of Saudi Arabia. The structure was opaque to American press. The capital was substantial, and the partnership had one purpose: buy more silver. The CFTC's later investigation named the partnership for the record. International Metals Investment Company, registered in Bermuda, capitalized by the Hunt Trust and the Saudi investors led by Sheikh Khalid bin Mahfouz. What followed was a self-reinforcing engine. Step 1. The brothers buy bullion. Spot price ticks up. Step 2. Every long futures contract they already hold is marked higher. That credited equity becomes margin headroom in their brokerage account. Step 3. With new headroom, they buy more contracts. Promises that someone will deliver real silver at expiry. Step 4. When those contracts expire, the shorts on the other side need deliverable silver to settle. The deliverable supply is finite. The Hunts have locked up a huge share of the silver the market can actually reach. So the shorts have to come buy it back from them at whatever price the brothers will sell. That is a corner. Each turn of the wheel makes the next turn easier. Between January and December of 1979, silver moved from $6 an ounce to $34. On the 7th of January, 1980, the Board of Governors of the Comex met an emergency session in their headquarters on Whitehall Street in Lower Manhattan. The minutes are short. The vote was not. The rule was 32 words long. It said that any trader holding more than 3 million ounces of silver in net long futures positions could, beginning February 18th, place only liquidation orders. They could sell. They could not buy. The rule did not name the Hunts. The rule did not need to. There were exactly 2 market participants in 1979, who held positions large enough for the rule to bind. One was the Hunt-Immick Group. The other was a single broker named Norton Waltuck, whose accumulation was being executed for clients later identified as the same Saudi investors inside IMIC. Silver kept rising for 11 more days. On Friday, January 18th, it hit $49.45 at the Comex peak. It is not clear that Bunker in Dallas fully understood what Silver Rule 7 had done to him. He had a thesis about inflation that had been right for 7 straight years. He had no reason to believe the Comex would write a rule for 2 private buyers and not for the people who had been short the entire time. What followed was not a crash. It was a slow erosion of 40 days. On February 18th, the Comex liquidation-only rule took effect. The Hunt-Immick position, the largest single buyer in the silver market, was no longer permitted to buy. Rule 7 did not make silver cheap. It made defending the corner impossible. The price slipped from 49 to 40, then 40 to 35, then 35 to 28. Each margin call required cash the Hunts had to find by selling something else. By mid-March, they were liquidating the family oil partnerships, real estate in Dallas, paintings, and racing thoroughbreds, all to meet the margin demands of a position they had been told the previous year was unbreakable. On March 25th, the brokerage Batch A. Halsey Stewart Shields issued a margin call to the Hunts for $135 million. The Hunts could not meet it. Batch's chief executive picked up his phone. March 27, 1980. Comex opens at 8:45 Eastern. Silver opens at $21.62 an ounce. By the closing bell, 8 hours later, silver is at $10.80. Silver lost roughly half its value in a single trading day. The Wall Street Journal called it, that weekend, the largest one-day percentage decline in the history of the New York metals market. Batch A, holding Hunt collateral that was suddenly worth half what it had been at breakfast, was on the brink of insolvency. If Batch A failed, the next brokerage in the chain would fail. If 2 brokerages failed, the silver clearing system would freeze. If silver clearing froze, the question was no longer whether the Hunts had lost their fortune. The question was whether the American clearing system itself was about to collapse. Paul Volcker had been chairman of the Federal Reserve for 8 months. In his 1979 memoir, Keeping at It, written almost 40 years later, he recalled the morning of March 27th as the moment he first understood that monetary policy and brokerage solvency were the same problem. The Fed could not extend money to the Hunts. The Federal Reserve Act forbade it. But the Fed could pick up the telephone. Volcker convened the chairman of 13 of the largest American banks. The lead bank was First National Bank of Chicago. The structure was simple. The 13 banks would syndicate a $1.1 billion line of credit to the Hunts. The line would be secured against approximately 63 million ounces of physical silver pledged by the brothers. The unwind would proceed in slow motion week by week, with the silver being released from the vault and sold into the market at a pace the market could absorb. The Fed extended no money. What the Fed extended was the phone call. The phone call was the rescue. 5 weeks after Silver Thursday, the Senate Subcommittee on Agriculture, Nutrition and Forestry opened hearings on what the press was calling the silver crisis. On May 2, 1980, Bunker Hunt was sworn in. His defense was that he had been hedging against inflation, not cornering the market. He had been buying silver because silver was cheap. He used the phrase more than once that silver was the cheapest thing he knew. The senators were not persuaded. The CFTC was not persuaded. 8 years later, a federal jury would not be persuaded either. In August 1988, a Manhattan jury found Bunker, Herbert, and IMIC liable in the Min-Pecco antitrust trial. The damages, trebled, landed at $400 million. 32 days later, the brothers filed personal bankruptcy under Chapter 11. The following year, the Commodity Futures Trading Commission issued Order 8912. Bunker Hunt was banned from trading on any American commodity exchange for the rest of his life. He died in Dallas in 2014 at the age of 88, with substantial wealth still in trust, but with a quarter-century of silence about the corner that bore his name. Silver settled below $5 an ounce by mid-1981. It stayed below $20 for the next 25 years. Most market historians do not credit Silver Rule 7 alone with the suppression. The corner had borrowed against itself for too long. It had pulled future demand into the present. The price the Hunts thought they owned was a price the market had agreed to only because 2 specific buyers were willing to keep buying. Once the buyers were forced out, the price had no anchor. The Hunt corner became the canonical case in CFTC manipulation law. It is taught in every commodity regulation seminar to this day, but the metal itself never knew it had been at the center of a trial. An ounce of silver in a vault in 1980 was the same ounce of silver in a vault in 2000. The brothers had thought owning the metal was the same as owning its price. The market disagreed.